What I'm about to say next, I don't say lightly, because it would put me out of a job, and for every other finance and stock market related personality, YouTuber, whatever, we would be obsolete, no longer needed. Reason being is that for most of us out here, if we were to just invest into SCHD, we would be good to go, whether it's in your working years or even if you're retired. SCHD and call it a day. Yeah, so see you guys, I'm out of a job now, peace. And what I just said to you, what makes all of this even crazier is that I used to be a fanatic hater of SCHD, especially in 2019, 2020, 2021, for the longest time. Reason being is that I always thought SCHD was just overrated, overhyped, and according to their historical stock price, I always felt like they were too pricey. SCHD, for the most part, was always near or around their 52-week high price. So I'm like, would I really want to buy in when they're at their all-time highs? No. And because everybody was liking it, I just felt like I needed to question and be skeptical about SCHD. I've always been the kind of guy that just goes against the grain. That's who I've always been. If everyone jumps off a cliff, dude, I'm not gonna follow suit. I'm gonna stand there and question, like, why are we jumping off this cliff? Just because everyone else likes SCHD doesn't automatically mean that I'm going to like SCHD. But I think the biggest reason as to why I did not like SCHD, especially for the logical side of my brain, is that I wasn't a fan of most of the holdings that are inside of SCHD. I think it has like over 100 different companies, plus or minus one or two, and some treasury notes. But for the most part, individual stocks that I would never ever invest into. Buying into SCHD would mean that I would indirectly buy into them and invest into them. And what I'm trying to say is that there are companies that I just do not believe in. And so the idea of investing into a business that I do not believe in, it didn't sit right with me. You're absolutely right. I'm coming off as like a whiner. I'm complaining about the little things. But ultimately, I also felt like their dividend yield was just not high enough, which is pretty crazy. Because when you look at their past 15 years, the historical dividend yield has been around 3.5%. Yes, it's just shy of, 3.49%. But luckily these days, at least in the past week or so, I haven't had a wise guy unnecessarily correct me by saying, hey, you're a liar, you're a cheat, you're a fraud. It's actually 3.49% and you're a liar because you said 3.5. We haven't had any of those. Shout out. Woo! But getting back to the video, as of recently, the dividend yield is sitting at 4.1% because SCHD, unfortunately, with the rest of the stock market, is going on an unjustified or a warranted sell-off. So 4.1%, it is quite juicy now, but historically 3.5%. So why and what changed my mind? So unlike most boomers that are arguing over nothing on Facebook, I am willing to be open-minded and admit if I am wrong, if in fact I am wrong. I'm humble enough to say if something is objectively beautiful and is juicy and is a dividend compounder with cheese, I'm not going to be that jerk off that's like, no, it's not. What are you talking about? I'm genuinely going to be like, okay, it is. It is an S tier, A+++++. And so I did my research with SCHD. And come to find out, their dividend yield is 3.5%, but the best part is it has been sustainable, meaning that dividend yield has been consistent and growing. Speaking of growing, their dividend growth rate for the past 15 years, they grew their dividend annually at a rate of 11.5%. Just pause and think about that for a second. Think about your favorite stock in the stock market. Do they grow their dividend at a rate of 11.5% year over year? Don't be a wise guy. I already know someone out here is going to be like, well, Visa, in fact, their dividend growth rate, Costco. Okay, I hear you. But 99% of the other dividend stocks, I think they pale in comparison, especially with their dividend growth rate. But also, once I learned what it takes to be a part of SCHD, it kind of swayed my opinion as well. Because the screening criteria, what you see on your screen right now, to join SCHD, it's pretty strict and it requires you to be high quality. Not all of them, but I guess on paper, they're high quality. Like number one, it emphasizes the free cash flow. You need to have manageable levels of debt. Your return on equity needs to be above average, and your dividend profile has to be solid. And I think what really sets SCHD apart from the other ETFs out there is that no single company can have more than 4 4% weighting in the portfolio, which is kind of outrageous and a scandal because when you think about the S&P 500, the biggest companies, the Mag 7, they have just way too much influence and power within that index fund. But for the Dow Jones US Dividend 100 Index, 4% or less for SCHD, I like it. I'm a fan of that because it distributes the power evenly and it prevents one stock from having too much bacon and eggs. It diversifies away your risk. Because let's say like SCHD goes all out, 99% into Chevron, the oil energy company, and Chevron ends up going belly up, then this index fund is going to be demolished, right? But with 4% capped, even if Chevron does decide to go belly up, they'll be okay. And believe it or not, on my non-existent dating profile, my bio literally says that as a dividend investor, I care about the performance and the total return. I don't just look at the dividend yield, because what good is it to have a 10% dividend yield if there's NAV erosion, or if my portfolio is going to be reducing year over year? Shout out to the Yield Max ETFs, whoop whoop. So with that said, what you see on your screen right now is the adjusted stock price total return for SCHD. I mean, the numbers speak for themselves, right? I don't need to sit here to justify why SCHD is amazing because their performance, historical data, does all the talking. Past 10 years, total return 180%. Past 15 years, 382%. If we want to compare that to the other dividend ETFs, let's see what happens, right? Another really popular one is the Vanguard's variety of SCHD, and it's VIG. So let's compare those two to see what happens. So SCHD in the past 5 years, we're talking about 97%. For VIG, that's 85%. I get it. It's not that much astronomically better, but objectively, it is still a little bigger or a little better. It's like if you're 5'9" and you go around telling people that you're 6 foot. You're 5'9". Stop lying, okay? Height inflation is a serious thing, just like the price of eggs and milk. They're also going up, but magically, how is your height going up as well? Just cut it out, okay? But maybe 5 years is not enough time. If we zoom out 10 years, oh, there we go. SCHD still wins, maybe by 3%. Not the greatest margin, but a winner is a winner. If you're not first, you're last. Nobody remembers the second place person in anything. In the World Cup, in the Super Bowl, we only remember the champions. And in this case, it's SCHD. And another really popular dividend growth ETF is the iShares Core Dividend Growth ETF, known as DGRO. And if we do the exact same benchmarking, we say something like, I don't know, 5 years, there you go, SCHD. If we do 10 years, SCHD once again. And if we do JEPI, which is a dividend income ETF, it's not necessarily a growth-focused one, but let's see what happens. Let's X out of this one. JEPI does not have the longest history in the stock market, but let's see what we're working with. Okay, at least 5 years. Past 5 years, 97% to JEPI's 63%. There's no way to spin it or manipulate it. SCHD is just better, pound for pound, in comparison to any dividend ETF out there. And just for fun, let's go ahead and compare it to one last dividend ETF, the S&P 500 Dividend Aristocrats ETF for the past, 3 years, 8% to that of 6%, 5 years, 97 to 73, 10 years, 179 to 134%. If we break that down year over year, I think that's where the compelling argument just becomes too compelling. The compound annual growth rate for SCHD for the past 10 years, 10.7%, meaning with the dividends and the share price appreciation combined, making a baby, then your money would have grown at a rate of 10.7%. For Noble, that's 8.8%. Past 5 years is 14.9% against 12.15%. We can play this game all day long. And sure, there's other dividend ETFs out here that might beat SCHD in 1 year or recently, or if you manipulate the timeline and say, well, for the past 600 days, but not exactly 900 days, then haha, SCHD lost. But over the long run and history, if we go objectively 5 years from today or 10 years from today, SCHD comes out on top like Patty the Batty against Michael Chandler. Dude, I saw that UFC fight yesterday. My goodness gracious, Patty just gave a brutal beatdown. It was, man, I am excited for that young man's future. And I say that because I've been cheering and supporting him for at least the past 6 years. I like him. I like him as a human, but I also like him as a fighter, especially what he stands for, men's mental health, and that he doesn't embrace that fake macho type A alpha male personality in order to beat the socks off of you. He can be silly. He can just be himself and still win. So I don't know. I guess you heard it here first. SCHD comparison to Patty the Batty, pretty similar. But with all of that said, SCHD is not without faults. They do have some blemishes, and now I'm going to talk about what I don't like about SCHD. And to do that, let's review their holdings, right? What is in the portfolio of SCHD? And what you see on your screen right now, the holdings are already prioritized based on their weighting and influence in the portfolio itself. So Coca-Cola represents about 4.4% of the portfolio, and so forth and so on. So Coca-Cola, yes, a good company. So I'll just basically tell you, would I invest into it, yes or no, short and simple. Coca-Cola, yes. Verizon, absolutely not. Lockheed, yes. Altria, yes. ConocoPhillips, no. PepsiCo, yes. Home Depot, maybe. Chevron, no. Amgen, no. Cisco, yes. Bristol-Myers Squibb, no. Mark, no. AbbVie, no. Texas Instrument, that's a maybe. UPS, yes. EOG Resources, no. So if you could see, there's a lot of pharmaceuticals and energy companies represented in the top 20. Am I a fan of that? No, because that's one sector I refuse to put any money into, the pharmaceuticals. If you're curious why I just said that, dude, I made a, I don't know, like a 20 or 30 minute video talking about why I, as a guy that used to be a strategy operations guy in a pharmaceutical company, why would I never invest into a pharma company? Watch that video to find out, okay? Scrolling down, we have One Oak, another energy company, Paychex, basically EOG and One OK, no, Paychex, not really sure what they are. Schellenberger, no. Kimberly-Clark, I was interested in them for the longest time, right? They were on my watch list because I think it's a pretty good, decent CPG company that makes anything to do with paper products. But for the past 5 years, as I alluded to earlier, dude, I care about the performance. And their performance in the past 5 years, it's not looking good. However, for a dividend income source that's qualified, I don't think it's the worst idea in the world, but as a guy that's 35, I don't think it has a place in my portfolio. Fastenal, no. Target, maybe. Ford, ooh, that's a tough one. Ford, maybe. Valero, no. General Mills, yes. Hershey, yes. Fifth Third, no. Darden, yes. Archer Daniels, no. Cincinnati Financial, no. T-Rowe, no. Coterra Energy, no. Halliburton, no. Watsco, no. Regions Financial, no. Snap-on, no. Packaging Corp, no. Fidelity, no. Best Buy, no. Yes. No. Why would I ever invest into an employment staffing agency? Headhunters, recruiters, Robert Half, absolutely a no. No. Maybe. I'm invested into this company. It's one of my biggest losers alongside with NVIDIA and AMD. But would I invest into them again? Maybe. Whirlpool? Maybe. No. Yes. Screaming yes. No, absolutely not. I made a deep dive video talking about Western Union. And based on what I found out, I would not touch them. Even if you were to be like, dude, I'll give you a $5 gift card to Sizzlers tonight so that you could eat a very overcooked steak. Would you invest into them? I would still say no. By the way, Sizzlers, not bad. Murphy Oil, no. Wendy's, oh my goodness. Can I get a number 2 with an extra large fries, please? Wendy's, I looked into them. Right? Because as an investor of McDonald's, I was like, is there anyone else out there doing, fast food burgers that have good financials and a good economic moat and a good bright future? Looked into Wendy's, no. And Huntsman, no. CVB, no. So as you can see, there are stocks, a majority of them I would never invest into individually. However, I think that's the beauty of SCHD. because this ETF does the dirty work for you if you want a high yield that is qualified. What do I mean by that? What I'm saying is, even though I might disagree with their recent rotation into oil and gas and pharmaceuticals, it's not like SCHD is going to marry those companies that I do not like. Case in point, those companies in their portfolio are going to be a part of this cult while they still meet the demands of the criteria and the metrics, the screening process. Then they eventually become replaced when they don't meet the cut. And I think SCHD rotates and rebalances their portfolio twice a year, every 6 months. So even if there's a company that I just really hate and despise and would be like, dude, that thing smells, 180 days, I probably don't have to see them again if their financials are eroding, if their fundamentals are declining, and they are in fact ugly, they're gone. They're not going to be there forever. And something else that I don't like about investing into SCHD is that there's an overlap of holdings, right? I invest into some of the stocks that are within SCHD on an individual level, like they're in my portfolio, such as PepsiCo and Flowers Foods. So to me, it's kind of redundant, but instead of seeing it as SCHD plus Pepsi or SCHD plus Flowers Foods, I just see it as SCHD. That's how I'm coming to terms with it and coping, because at the end of the day, if we scroll back up and look at PepsiCo, their weighting is 4%. So it's not exactly an ETF that screams, hey, it's all about PepsiCo. It only makes up 4% of the portfolio, because ultimately the other 96% of the portfolio comprised of other companies. So it's not just PepsiCo. And lastly, something about me, I'm a very sympathetic person. If I see someone going through a loss or suffering or grieving, dude, I'm going to be right next to them, crying with them. I've always been that kind of guy, right? Emotional. But it doesn't pertain to me. However, I know for my international friends out here, SCHD is just not available for you guys. And that's something that I don't like about SCHD. It just rubs my nipples the wrong way and makes them really dry to know that some of you guys that actually see the light and know how good SCHD is, you still can't buy into it because of where you live in the world. And I think that's stupid, but whatever. But ultimately, by the way, I live in Japan. That's why my sparkling water right here has all these fungi kanji and characters. Dude, the sparkling water in Japan, 10 times as aggressive and bubbly to that of the American equivalent. Not a joke. You drink this, you will be burping out of your butthole all day long. And they in fact call it strong sparkling water. When they say that, dude, they're not joking around. But ultimately, my goal, especially in my working years, is to eventually get SCHD to about 50% of my portfolio weighting. And then, of course, the other 50% will be in individual stocks or REITs or BDCs. As of right now, funny enough, I only have 10 shares. This week, I'm hoping that the price does dip below 24 bucks again so I can pick up an additional, shout out, 5 to 10 shares. Woo, big money right here, 5 to 10 shares. So remember what I said in the beginning of the video? I'm being serious. Most people, SCHD, call it a day. By the way, that's not financial advice. I'm an idiot. I don't even know what I'm talking about. I literally sit down to pee. I'm ugly. And my hairline is receding year over year. What do I know? Not financial advice, but SCHD, call it a day. At least it is for me. Why am I saying all of that? Am I having a midlife crisis? Are my feet small? Do I have no friends? Yes. Yes to all of that. But more importantly, Mr. Seahawk, I think I can confidently say SCHD and call it a day because SCHD is better than a majority of dividend stocks out here. We're going to do a little exercise. SCHD against some compounders that I own in my portfolio. First up in the arena is going to be PepsiCo. And if we zoom back, I think 1 year is not fair. Let's go ahead and say something like 5 years to get a real fair assessment. Past 5 years, SCHD, 97% adjusted stock price total return. For PepsiCo, 26.5%. Past 2.5 to 3 years, Pepsi, they've seen better days. It's not been a good timeline in the stock market for them. If we zoom out 10 years, we're talking about 179% to Pepsi's 100%. If we do 15 years, 382 to PepsiCo's 235. So PepsiCo, I would absolutely label as a dividend compounder with that Parmesan, that mozzarella cheese. They got that X factor, the economic moat, fundamentals, the financials, their dividend history. I think they've been growing their freaking dividend for the past 53 and a half I think it's 54 years now. Looks good, but SCHD just takes a hot steaming dump all over the head of PepsiCo, smears it in, and makes their hair look like mine. This is called a slick back, by the way, which, believe it or not, I never had this hairstyle until about 6 months ago. Because a year and a half ago, I used to rock a mullet, which, I don't know, dude, it looked cool at the time, but I'm no longer doing a mullet. And then before that, I had the traditional Korean haircut, the 2-block and everything, but yeah, slick back. Which, funny enough, come to think of it, I feel like feces and fecal matter and poop would be a really good hair gel wax, because I feel like it would hold the hair down, but would I ever want to put SCHD's poop into my hair? Dude, I don't know, man. There's having bad days, and then there's also putting poop of SCHD into your hair because you feel like it's going to hold your hair down well. Yeah, I'm going to have to say no to that, Chief. And if we compare it to another company on an individual level that I do invest into that is within SCHD, but I also hold into it individually, did I just say the same thing twice? But anyways, if we do Flow, which is Flowers Foods, I just made a video about them. Absolutely a dividend compounder with cheese as well. I think 1 year is not a fair assessment. If we zoom out to, I don't know, something like 5 years, talking about 97% to that of 0.79%. If we do 10 years, 179 to that of 13%. 15 years, 382 to 169%. Once again, SCHD beats another individual stock that I hold in my portfolio. Let's just close out of them and we'll compare it to one more, which is General Mills, a company that I do own. Let's see how it pans out in this fight. So if we scroll up right here and we do 5 years, SCHD, 97% total return. When I say that, I'm saying in a span of 5 years, your return on investment would have grown by 97% by holding on to SCHD. Does that make sense? So 97% to 18%. If we do 10 years, 179 to 44. If we do 15 years, 382 to 171. That is absolutely wild. But you might be like, then why the heck did you buy into PepsiCo, Flowers Foods, and General Mills? Why? Because as of right now, I truly think that the food CPG companies are undervalued and they're being rotated out of because of a high inflationary environment where consumers are spending less to buy the name brand box of cereal or the name brand soda. However, when things go back to normal in 2 to 3 to 4 years, they should be back on course and on pace to reach new highs again and crushing it, and their stock price should reflect their business operations. So would I want to buy into a company when they're at their all-time highs and they're very expensive like Costco? Or do I want to buy into a high-quality company while they're currently walking with one crutch because they stubbed their toe on the couch while walking in the dark and now they're beat up and now they're cheap? I like to buy it while they're kind of on that discount. Do I see them disappearing tomorrow? In 5 years, 10 years? No, they're consumer staples. The grocery food stocks are not necessarily the most sexy. They're not going to be spewing words of AI or cryptocurrency. But it is a business operation and a necessity that we as Americans and international folks around the world consume day to day. It's something that's going to be here today and here tomorrow, and I would rather buy it now while it's cheap, rather than 10 years from now regretting it like, dude, why didn't I buy PepsiCo while they were at their 5-year lows? I'm so dumb. Instead of saying that, I'm like, dude, I'm just going to pull the trigger, put my mouth where my foot is, put my nipples. I always forget how to say that phrase. Put my money where my mouth is. There we go. And I'm doing it. And I'll report back to you guys in 5 years whether or not I was stupid. However, with all that said, it's not all rainbows and sunshines. It's not like SCHD is pooping gold. Okay, because there are individual stocks, dividend compounders that are pound for pound better than them. First up, another company that I just added to my portfolio. Let's talk about ARK. I just added them a week and a half ago. Who do you think is going to win? A BDC with a very high dividend yield. It's like 10 point something percent right now versus SCHD. Their dividend yield is 4.1%. I gave you enough time so that you can respond in a comment down below to see who you think would win, because this shocked me, okay? So if you zoom out 5 years, SCHD 97%, ARK, the BDC, 147%. Shout out to them because right now they are fundamentally undervalued. They're trading right below their NAV per share price. I am buying into them. And let's, what am I saying here? Okay, if we do 10 years, let's see what's happening here. SCHD 179, ARK 200%. So ARK beats SCHD. And if you're skeptical, because you have every reason to be, because it's like, who would have thought a BDC would outperform SCHD by this much? Check this out. If we do 15 years, are you ready? Pull up your pants, okay? Look at this. 15 years, 439% total return for ARK. For SCHD, it's 382. So for me, it's also a no-brainer that I am going to be investing into ARK as they continue to trade at around like 1990. If they drop down to like 1890 again, that sounds like the title of a movie on Netflix, 1890. But anyways, as they continue to trade around those valuations, I think ARK is a very easy yes for me. That's not financial advice. Shut up. It is not financial advice. I'm just telling you what I'm doing, okay? Because as you can see, the data speaks for itself. So speaking of data telling a story, tell me what you see with Flowers Foods right now. Their total return in the stock market is 23,292%. Past 5 years, yes, they are struggling, but if we zoom out and we look at the data objectively, that is a dividend compounder with cheese. Likewise, PepsiCo. I wonder what their history looks like. Yes, they're having a rough 5 years. However, tell me what you see. The all-time total return, at least according to Yahoo Finance, 1985 until now, is 8,900%. As you can see on your screen, when they go up, they do have natural corrections, such as right after the Great Recession or during the pandemic sell-off, and as of right now, during this high inflationary environment. Yes, past performance is not indicative of future gains. However, as I can see from their company history and data, whenever they go on a massive sell-off and they hit the valleys, eventually they do find a way to rebound and find a new high because they acquire the competition, or they scale their operations, or they just figure out a way to optimize their inventory or whatever it is that they're trying to do. So PepsiCo, also a dividend compounder. And last but not least, for General Mills, I wonder what their total history looks like. 5,300% since 1985. I guess Yahoo Finance only goes back to 1985, but also a dividend compounder with cheese. That explains why I am investing into them, because it's in their DNA and timeline and history to be a compounder. It's just right now they're going through a rough patch. And so I would rather pick them up while they have that one crutch, because I know they're going to be okay. I'm not talking about a speculative tech startup that is burning through cash, that's not profitable, that has zero free cash flow, that can't even afford a dividend. As a matter of fact, PepsiCo, General Mills, and Flowers Foods, they're doing okay. Are they seeing growth numbers like Palantir or Microsoft or Google? No, but they're not trying to be. They're a stable, slow and steady, patient investor type of company where you take them on a date, you get to know them. You repeat that experience 10 times, you bring them home, you get to know each other. It's the slow race. With Palantir and some of these growth companies, it's like going to a nightclub or the bar, meeting someone and saying, I'm going to marry them the first 20 minutes that you met them. It might be hot and get the blood going to the top of your head, and it might help with the receding hairline if you increase the blood flow. I think ancient Chinese medicine says something about that, but it might be a cool story. However, it can crash and burn just as fast as that passion and love blooms. Whereas with something boring, a business model like General Mills, dude, they freaking make cereal. Dude, I'll take that any day of the week. For the patient, for the slow and steady, for the hare, the rabbit that's in the race, the tortoise. No, it's a tortoise, right? The tortoise is the slow one, whereas the rabbit is the one that's like, hey, I'm already done. But one thing that I've learned in my short period of life is that the slow and steady, the consistent, the one that shows up every day, regardless of having a sexy face or not, are usually the winners in the end, especially in the realm of the business world. Getting off my soapbox, let's get back to SCHD. Okay, so that was ARK versus SCHD. Now I want to talk about Google. Parent company is known as Alphabet. Another dividend compounder with cheese that I personally think is one of the best beginner stocks in the stock market. What quantifies a beginner stock? Something that is really high quality, easy to invest into because it's a no-brainer. Old, young, ugly, handsome, short, fat, it doesn't matter. It's good for almost anybody on a universal level because it's such a high quality compounder. Google, super easy yes for me. Yes, I am invested into them, but another exercise that I want to show you is, let's see who wins, right? If we zoom out 5 years, 97% to that of 160% for Google. If we do 10 years, 179 versus 475. 15 years, 382 versus 1,000%. If we break that down year over year, it's going to get funny money. Google, we're talking about 17% year over year your money would have grown. Whereas for SCHD, 12% in the timeline of 15 years. If you shorten it to 10-year timeline, then it's 19% versus 10%. So another example of how SCHD is not pound for pound the best fighter. Because in my opinion, I think that's Johnny Bones Jones. I think John Jones is the best fighter. And unfortunately, SCHD is just not him. One more. Okay, we'll do one last comparison. So it's SCHD versus Microsoft. This is another dividend compounder that I think fits that definition of being a best beginner stock, because it's so easy to invest into, high quality, a compounder, a business that will compound your wealth. By the way, that's not financial advice. I'm just speaking out of my butt. But it's a really good business with an economic moat, a subscription business model, solid. If we do the exact same experiment, who do you think is going to win? Well, let's see. 5 years, 97% to that of Microsoft's 145. If we do 10 years, 179 to Microsoft's 978. 15 years, 382 to Microsoft's 1,500%. But it is worth mentioning, in the early 2010s, like 2010 all the way up to like 2018, Microsoft was basically Disney. It essentially traded flat. It would go up and down, but not by too much. It was a very boring business. But in the past 5 years or so, dude, Microsoft has just been turning into an aggressive growth company because of their cloud endeavors, AI, and they just acquired Activision Blizzard, which if you are a PC gamer, you know that's a huge acquisition. So Microsoft, I think, is a very solid company that turned a boring business model that was kind of like Cisco, that was one of those ancient tech companies like IBM, but they found a way to be relevant and to be at the top of the game. So Microsoft, I think, is one of the few companies out here that is a buy and hold, at least for the next 20, 30, 40 years. I think with most investments, we do need to check up on the investment thesis, their story, their operations, and how their future looks for the next 6 to 12 months. But for Microsoft, it's almost as safe as just like a 401k investment of just putting your money into an S&P 500 index fund. That's how strongly my convictions are for that company. So all that to say, SCHD is awesome, but it's not perfect. But let's take a time out. Why am I referring to SCHD like you're joining a cult? Well, I call investing into SCHD like joining a cult because I think every investor goes along a similar path, right? You either begin by chasing high dividend yield traps or value traps, or you're attracted to this speculative growth crap that will 10x your money overnight, or you lose everything in a week. No in between. But no matter where you start on the spectrum, eventually in the end, we all become quality dividend investors. You might be a dividend income investor or dividend growth investor. Doesn't matter the variety and flavor, but eventually you start caring about the financials and fundamentals and only investing into good businesses that can sustain their dividend, but also have a bright future with a sustainable and positive free cash flow. We start caring about things like that rather than just looking at the superficial of like, oh my gosh, their dividend yield is 25%. Or, oh my goodness, this company said AI 250 times in their last earnings report. Instead of thinking about stupid crap like that, you learn to drown out the noise and focus on what truly matters, the fundamentals and metrics that are actually important. And the reason being is that once you get burned enough times, or with wisdom, you learn that the slow and steady methodology is the way to go in the stock market. If anybody tries to sell you the idea of 20xing your money in a span of 1 year or overnight, dude, they're an idiot. That's a lunatic. But as we learned with SCHD, Microsoft, Google, Arc, and some of these other companies, if we're talking about 4xing your money in a span of 10 years or 15 years, that's more realistic. And that can only happen with a high quality dividend compounder with cheese. Yes, there are some speculative biotech pharmaceutical companies that can also 10x your money while having shaky financials, but we're not going to get into that because we don't promote that kind of crap on this channel. Not financial advice. All that to say, if you do not like SCHD, please tell me why. Because I used to be just like you, right? Pooping before I shower, eating a bowl of cereal with water, and wearing the same underwear 5 days in a row. Eventually, we all come around. I think that's hilarious. With enough time, eventually all of us do become an SCHD investor. And what's really funny is, unrelated to SCHD, right now the hottest fad and trend in the dividend investing community, yield max ETFs and the round hill weekly ETFs. Everybody is raging about it, and I'm gonna make my response and a video on why what do you think the fill in the blank is gonna be? I nipple them, I adore them, why I don't like them, and why I avoid them. I'm gonna make that video soon. I'm gonna upload it. I'm gonna articulate my thoughts. Dude, I'm not falling for yield max or round hill. So if you're interested in hearing my logic and perspective, by the way, dude, it's raining like crazy here in Japan today, then subscribe to the channel. That way you don't miss that upload when it goes up. Take off your Crocs, enter the Dividend Dojo, and strike the bell of compound interest. The cult welcomes you home. Anyways, I love you guys. Stay safe in the stock market. Good luck. And remember, I'm not a financial advisor. I'm just a random ass guy on the internet that showers naked, and I like dividends. All that to say, talk to you guys next time. Peace.